Today for our learning session, we are going to do an AEC insurance market update. This is going to be brought to you by one of our great sponsors, IMA Financial. They are one of the largest independent insurance brokerages in the country that can help you out in ways like you probably don't realize. Dan is a new resident, it sounds like, to beautiful Las Vegas out there. So if any of you guys were at our conference last year, we hope to be back and visiting around Dan sometime soon. But Dan is originally, it sounds like, from the Kansas City area, and I'll let him do some more of his introduction. But thank you, Dan, for joining us today and covering this important topic. So I'll hand it over to you. And if anyone has any questions, like I said, please try and use that Q&A function, and we'll get to those towards the end of the presentation. Thanks.
Okay, thanks, Chad. And thanks to the Zweig group for giving IMA and myself the opportunity to participate in this year's virtual conference. We would obviously love to have been in person in Denver or anywhere else that the conference might be in the upcoming years. So we hope to see everyone down the line. I want to thank everybody for joining and spending an hour of your time listening to an insurance nerd talk about insurance. So we'll try to hopefully get some of your questions answered and talk about some things that are maybe on your minds. So I'm Dan Britton. I'm the director of the professional services practice for IMA. We are, well, I'll talk about IMA for about 30 seconds here in a second, but just a little bit of background on myself. I've been in the insurance industry for almost 15 years and spent the entire duration of that time with focusing on a specialization in professional liability, particularly for architects and engineers, and to a lesser degree for design build contractors and other consultants in the A&E or construction industry space and dealing with their professional liability type exposures. So the things that we'll talk about today, really I want to give everybody just a really brief intro and background on some insurance topics, and we'll talk about some macro factors that are impacting the insurance industry, and obviously one of those being COVID-19. We'll talk about how that's impacting the AEC market, and then we can talk a little bit more in depth on some specific things that underwriters are looking for from an A&E professional liability standpoint. Like I said, I've been doing A&E professional liability for almost 15 years, and I've seen, put together programs and dealt with clients in the annual billings range, from 2 to 3 to 5 million, all the way up to design build contractors or some of the largest A&E firms in the world doing, more than $1 billion up to 10 billion in annual revenue. So I've kind of seen clients that run the gamut, and been involved in a lot of complex or interesting developments with those clients. So just 10 seconds on IMA. We are the 6th largest independently owned, privately held insurance brokerage in the United States. We do around 200 million in annual revenues, and one of our largest industry practices is our construction practice, where I sit on the professional services team. So what we'll talk about today is just some really basic insurance 101, and I'll try not to bore you to death with that. But then we'll get into some market update information. We'll talk about some recent trends that are impacting the market, and then obviously what's being seen and what's being looked at with respect to the pandemic, how that's impacting the economic environment for AEC firms. I think most of you in the audience here probably know that better than I do, but at least I'll give you a feel for what the insurance industry looks at, obviously when they're looking at the professional liability space for A&E firms. And then we can talk a little bit about some claims trends and some underwriting considerations that your underwriters are looking at when they evaluate your firms, and then obviously some Q&A at the end. So let's just jump right into the basics of insurance. And at a really fundamental level, insurance really exists to allow the basic function of risk transfer to occur between the policyholder and the insurance company. Obviously, what this does is allows the insured or the policyholder to better manage these large exposures to potentially catastrophic losses that, without insurance providing funding for those losses, would be generally too large of an exposure for individuals or businesses of any size to confidently plan for the future from a financial standpoint. This really works because of this concept of pooling of risk that allows, provides a mechanism for insurance companies to better understand and evaluate the losses that they may be forced to pay based on the policies that they write. Obviously, if someone is writing homeowners insurance for 10 million homeowners, it's a lot. They can much more confidently predict with actuarial models and other risk analysis tools the likelihood that they'll have claims against those 10 million policies, and then charge a fair premium for the assumption of that risk, as opposed to just an individual single homeowner who has to set aside funds for a potential damage to their house, whether it's water damage from faulty equipment, or whether it's something weather related, or hurricanes, hail damage, etc. It's provides a tremendous benefit to society as well. As everyone probably knows, most things don't happen without insurance, and that's simply because the investors or whoever's funding a lot of investments, whether it's construction projects or new businesses, they want to make sure that their investments are protected from potential catastrophic loss. So you'll see insurance requirements in just about every part of the economy. Insurance companies, I just wanted to talk a little bit about the way that they're evaluated, both internally and externally. And there are two really common ratios that are talked about in the insurance market: the loss ratio and the combined ratio. And the denominator in both ratios is the same, total earned premiums. But in the loss ratio, they're really just taking losses divided by premiums. It's typically referred to as a percent. So if an insurance carrier writes $100 million of earned premium and they have, let's say, $50 million worth of losses against that premium, they're going to be looking at a 50% loss ratio, and that really allows them to measure their underwriting profitability or underwriting success. Meaning for every dollar of premium that they collected, they paid 50 cents in claims, which means they had a 50-cent underwriting profit. The combined ratio takes that one step further, and it includes in the numerator the expenses, and obviously those expenses are associated with salaries of underwriters and back office people, actuaries, accountants, real estate costs, dividends to shareholders. It's really meant to account for just about everything in the operational aspects of running an insurance company. So the combined ratio is more a measure of overall profitability at the operational level for that insurance company. So when you add the expenses into the losses, if you're looking at a combined ratio in excess of 100%, that insurance company would essentially be looking at an operational loss for that policy year or that period of time. Obviously, if you collected $100 million in premiums and you had 50 million in losses and you had 55 million in expenses, we can all do that math pretty quickly and know that there's a 5 million loss at the operational level. However, there is a third piece to the puzzle that insurance companies will look at when evaluating their business and make changes as they go forward. Obviously, they can, the first two are easy and right within the ratios themselves. They can strive for better underwriting results by doing things with their appetites and the types of firms that they're willing to take on as insureds. They can charge more premium for their policies, all sorts of things. Maybe they can put out less limits to help manage that underwriting profitability side. And then, of course, everyone's probably familiar with expense management and things that can be done there. Consolidating regions into bigger regions, or reducing staff, or whatever the case might be. Obviously, IT can help play a part. But the third piece of the puzzle really is investment income. There's a really good discussion on this topic every year in the Berkshire Hathaway letter to shareholders that Warren Buffett writes, and he talks about really the beauty of being an insurance company and being able to collect premium from policyholders and then hold on to that premium for a period of time until the claims are made against those policies. And in some cases, the claims might be made, very quickly. And in the case of property insurance, you generally have claims made the year that you wrote the policy. But other types of insurance, the claims might not be made for 2, 3, 4 years, 10 years, or longer. So the insurance company has the benefit of that cash that they collected in premium, and they can invest that cash, collect interest on that cash, and then when they turn around and pay claims against those policies, they've in some cases have been able to subsidize underwriting losses based on investment income. Now, with that being said, there are some restrictions on the types of investments that insurance companies can make with the funds that they collect via policy premiums. So really, insurance carriers are more often than not looking at the interest rates on 10-year treasury notes as a barometer for what they're likely to be able to achieve in that investment strategy side of the equation. So if you look all the way back to the 80s and 90s, insurance companies could operate at combined ratios of 110 or maybe even 120%, and still at the end of the day be profitable because their investment returns were, to the point that they could subsidize those operational losses. And obviously, you can see in this graph here, I think the current interest rate was like 0.7% as of a couple of days ago when I pulled this data. So the investment returns just aren't there anymore for insurance carriers with the float on that they're able to invest. So they no longer have this sort of third piece of the puzzle that is subsidizing and propping up their operational losses, which has forced them to shift their attention towards making better underwriting decisions or charging more premium for their policies. And with that, we'll sort of transition into an update on the insurance market in general. And I started out, I just wanted to sort of give everybody a feel for what's being said in the market, some quick takeaways from some recent publications. This first one is a publication by USI, which is a large insurance broker competitor to IMA. But this is what they said in their industry insights report entering the third quarter of 2020. So this would have been around July timeframe. They talked a lot about the challenges facing the industry and that they fully expect the industry to continue to harden through the rest of 2020 and well into 2021. And by harden, they mean pricing rates going up, capacity being restricted. You might have seen insurance carriers that previously would offer a $25 million limit. They may be only willing to offer $10 million in the future. and then other negative trends, and those are usually associated with exclusions or restrictions that are added to policies to try to avoid paying certain types of claims. A second publication that really just came out at the end of the third quarter, so early in October, from Market Scout, who's sort of an industry data aggregator and reports on the industry rates every quarter, and they concluded, based on their aggregate data that they've collected, that the average insurance rate increase for commercial insurance buyers in the third quarter was 6.25%. That's after multiple quarters of average increases. So it's been going up for quite a while, and people expect that it will continue to go up into the future, into 2021 and probably 2022. So some of the things that insurance carriers are facing that are causing these price increases to happen, to be necessary, are obvious when you really think about them. But the problem, and we'll see in a few slides, is that insurance carriers just haven't really been keeping up with these problems. The market has been soft for a long time, probably 20 plus years. There's been a lot of new insurance companies entering the market, providing a lot of competition, and the insurance carriers just haven't been able to get the increases in rates that they would have liked over that long stretch of time, and it's all sort of caught up to them all at once. So now they're taking sort of drastic measures to correct their book. Some of the things that have sort of caught up to them all at once, obviously severe weather. It used to be that the property insurance market was just extremely lumpy. Insurance carriers might go multiple years in a row without a huge natural disaster type claim. And so they could bank their premiums year after year after year consecutively without a big event. Now it seems like there's big events multiple times throughout the year, every year, whether it's California wildfires. We've got a hurricane bearing down on the Gulf Coast right now. We've had Hurricane Harvey in Houston, but even just things that didn't used to cause $1 billion in damage, now they are. We've had in the Midwest, we've had hurricanes in Joplin, Missouri, and other places that have just been catastrophic losses for insurance carriers, and it's putting a lot of pressure on the rates for property insurance that really never went up accordingly over time, and so they're taking all of their rate increase sort of in one fell swoop. On the liability side, we're seeing litigation strategies that have evolved and have resulted in a more savvy plaintiffs bar that's been able to extract larger settlements or larger jury verdicts. Some of the things that are happening that are leading to those outcomes on bodily injury type claims, we're seeing a big increase in the use of these physicians' letters of protection. And really what that is it's a fiduciary agreement between the plaintiff's attorney and the treating physician that the medical expenses will be paid for out of the funds from the jury verdict. Typically any medical expenses that are awarded by a jury verdict would be reduced by the amount that those expenses would be normally reduced if private health insurance was paying for those services. But we've seen a lot of cases where the injured plaintiff doesn't have private health insurance, or maybe the treating physician is out of network, and so those reductions don't apply. So it's inflating the value of the awards. And also it sort of gives the treating physician a financial interest in the outcome of the case. And they can probably prescribe things, treatments, or procedures that may not be medically necessary, but they know that they're going to get paid for them, and they don't have an insurance carrier that's necessarily watching what they do for any sort of reasonableness. We've also seen third-party litigation funding that's evolved to essentially what it is private equity groups or other sources of funding, totally unrelated to the plaintiffs, that are providing litigation funding to those plaintiffs, and it's allowing those cases to have a litigation budget that matches or exceeds the budget from the corporate defendant or the insurance carrier that's on the other side. So it really levels the playing field from a resource perspective. Defense attorneys used to be able to just inundate the plaintiff's attorneys with massive amounts of discovery or whatever else. I mean, we've all probably read a John Grisham novel to that effect. But the playing field has been leveled with this sort of evolution to include third-party litigation funding. So more cases are making it all the way to a jury verdict because they have the funding to get there. They're able to afford better attorneys, better expert witnesses, and it just keeps them in the game longer. We're also seeing auto liability trends. Everybody's probably got at least one or more than one smart device in their car while they're driving, and distracted driving is leading to more accidents. Repairs for vehicles continue to get more and more costly. And obviously any bodily injury that's resulting from an accident is more costly on the medical side as well. The economic environment certainly is impacting insurance carriers. We talked about the prolonged low interest rates, for the last 10 or 20 years, but we've also got this other side of the coin, which is the rising cost of medical care, and it's far outpacing the normal inflation across the country. So insurance carriers haven't been able to collect more premium or haven't seen inflation pressures, increasing exposures or premiums that they've collected, but certainly on the claim side, they've seen it increasing the value of those claims. And then lastly, and something that we'll dive a little bit more into is insurance carriers are facing significant pressure from what they're calling social inflation. And that's just simply the idea that societal and legal factors are promoting more lawsuits with larger settlements and bigger jury verdicts. And the things that are happening that are, there's been a lot of research into this because it just hasn't happened overnight. But some of the things that people believe are causing this is we've got the millennial generation that is packing jury boxes these days, and not only millennials, but to a large extent, America in general has big anti-corporate beliefs. I think these are stats from a recent Gallup poll. 71% of Americans feeling that big companies put profits ahead of safety. 80% of Americans feeling that expect corporations to take every precaution to ensure safety. And when they say that, it's regardless of the cost of those precautions. There's a culture of blame throughout the society. If someone's injured, someone must be responsible for it. Somebody must pay, and let's find the deep pockets. The plaintiffs' attorneys have become much more savvy in the way that they appeal to jurors' emotions, really convincing them to set aside the facts of the case and to just quote unquote do what they feel is right. Oftentimes what they feel is right is for the insurance company, several billions of policyholder surplus on their balance sheet to just pay the injured party, the plaintiff, tens of millions of dollars, because it's not going to have a huge impact on the insurance carrier, but it's going to change that person's life. This has obviously led to the industry and across the country seeing what what they're calling these nuclear verdicts. And you can see, I just put 4 examples here. These are astronomically big numbers and really head-scratching verdicts. They're not grounded in any sort of standard logic or reason that we normally would see jury awards tied to, like returning someone to the state or condition that they were in prior to the injury. The juries are just as interested in punishing the corporate bad actors to a great deal. This is, like I said, this is just 4 examples. I think when I was putting this presentation together, I had come across reference source material with hundreds of cases across the country that are head scratchers. And I know AIG in their excess casualty umbrella liability book of business, just insurance industry wide, they track every year the largest 50 claims that hit their umbrella excess book. And so these are claims that they physically are involved in and pay. And the frustrating part for them and for any insurance carrier is those 50 claims, they come from 50 different customers every year. There really aren't, in these big claims, there really isn't any predictability in which insured or which policyholder is going to present that claim to you. That's going to be, you're paying 25 million of a $200 million claim. So without really being able to tell confidently where those claims are going to come from, they can't just charge those 50 insureds an increased premium because they know those are the ones that are going to present the claims. They have to charge everyone across their entire book of business. And it sort of gets back to that pooling of risk concept that we talked about at the beginning. So everyone's going to see some sort of a rate increase on their umbrella premiums, even though, not everyone's going to contribute to the losses. And that's obviously a frustrating part of buying insurance, but it's the only way that it really works. Otherwise, the insurance companies wouldn't be able to withstand the losses themselves. This is data from Chubb in their excess umbrella book. And you can see in the blue line, since 2007, the frequency of claims that they've seen, just purely the number of claims that have been submitted to them, is relatively flat over that entire period of time. The green line, however, is the severity or the dollar value of those claims. And obviously it's gone up significantly, over 120% in that period of time. And the yellow line is the rate that they've charged for their insurance in terms of premiums. Obviously, you can see it went down for some period until around 2010, 2011. Just a lot of capacity in the marketplace and people thinking that they can make money writing excess umbrella business. And so there's been, just too much competition and too much pressure on rates to go down in order to retain business that, carriers had to sort of, keep the business that they had that they thought was profitable. And so at the end of the day, they've sort of come to this time of reckoning that we're in now, where, there's this 130% gap between the rate that they're charging and the claims that they're paying. And they're going to have to close that gap one way or another. Obviously, they can charge more for the premium. They can charge more premium for the policies that they write, but they can also try to have an impact on the green line and pushing that back down. And some of the things that they can do is add exclusions to policies to not pay for certain types of claims. They can adjust their underwriting appetite to not offer excess umbrella rate limits for certain accounts. They can increase their attachment point. It used to be maybe everybody had a $1 million GL and then you bought umbrella on top of that. The umbrella underwriters are starting to say, we want to see at least 2 million in your GL before we'll attach. And obviously they can reduce their limits. And like we talked before, if somebody was writing a $25 million lead umbrella, maybe they're only willing to offer a 5 million or a 10 million lead umbrella. And you've got to go to a different carrier to find the rest of the limits. That's obviously a significant problem for these carriers and something that they're trying to address. And, it's the brokers like IMA and others who are, trying to smooth this correction out over multiple years rather than have our clients face just hugely dramatic increases all at once. And obviously we haven't even talked about COVID yet, but all of those things that have been impacting insurance carriers and have been on their minds for quite some time were all happening before COVID even got on the radar screen in, I guess, January or February, and really the full scope of the pandemic and the shutdowns happened in March. So now insurance carriers are dealing with the fallout and continued uncertainty from the pandemic. And some of the things that they're watching specifically, they're obviously watching issues with respect to return to work as employees move back into work environments across the country and have to quickly learn and adopt new procedures and new protections, processes to stay safe and to keep their customers safe. Obviously, it's just ripe for claims and litigation. They're looking at these what are being termed presumption laws that are popping up across the country, and California and Illinois actually have already adopted them. And these impact work comp benefits, and they essentially say that at least now it's limited to essential workers. But for essential workers who contract the virus, the law requires that there's a presumption that they contracted the virus through the scope and course of their duties as an employee, which means their work comp coverage provided by their employer has to respond. Obviously, that's a significant shift from the general standard of having to prove that you contracted the virus or the disease or whatever it was through that scope and course of your duties as an employee in order for work comp to respond. So they've taken the burden of proof away from the employee and just said, we're going to presume that you got it from your job, from working, and therefore work comp will apply. Carriers in those states that write work comp business are obviously going to see an uptick in work comp claims and the value of those claims, and they have to monitor those things, and they'll have to charge more for that insurance because they're going to have claims going up. And then as economies reopen further, as employees go back to the workplace, we talked about sort of this anti-corporate sentiment across the country, and we talked about this belief that businesses really owe it to their employees to take every measure, every precaution possible, regardless of the cost, to keep their people safe. Obviously, we know that people are going to contract the virus. It can't be contained 100%, no matter how hard we try. And so there's going to be claims. People are going to make claims against their employer or the business that they patronized over the weekend or whatever the case might be. Employers are going to be dealing with fallout from employment type claims, whether it's reducing people's wages and hours or furloughs, involuntary furloughs, other types of claims. It really is too soon to know how it's all going to play out, but insurance companies fully expect that they're going to see more claims. I will say, just 10 seconds, that there's a link here to this IMA COVID-19 Alert Center. We've been publishing, at the outset in March, we were publishing something twice a week for specific industries or broad issues, recommendations on filing claims with your carriers, all sorts of data out there, and that's publicly available on our website. And that doesn't even take into account, the impact of COVID-19 on business interruption insurance, which is typically a part of most property insurance policies. So there's almost 1,000 cases in active litigation across the country, and the central issue that they're really arguing over between policyholder and insurance carrier is whether the presence of COVID-19 particles qualifies as direct physical loss or damage to covered property that's insured by the policy. And the trigger for any property insurance policy is some variation of that phrase, direct physical loss or damage to covered property. The insurance industry has probably done a really good job of dissuading and discouraging policyholders from submitting claims for business interruption losses, because it sort of seems intuitive that the virus itself, or the possibility that the virus might be present at your business, isn't direct physical loss or damage in the way that we think of traditionally with respect to property insurance. We're talking hail damage, fire, flooding, water intrusion, windstorms, etc. But But as you can see, there is some developments here. There's a case in the I think the Western District of Missouri federal court system, Studio Fort 17 versus the Cincinnati Insurance Company, and the court agreed with policyholders that the particles were the COVID-19 particles were a physical substance that attached to and damaged the property, rendering them unsafe and unusable. And I will note though that the Cincinnati policy in question did not have a virus exclusion on the property policy. A lot of carriers do have the virus exclusion, so the insurance carrier defense is strengthened a bit by being able to point to that virus exclusion specifically, whereas Cincinnati was purely arguing that COVID-19 itself was not direct physical loss or damage. Obviously, this case is still working its way through the system. I believe it's in discovery now after the judge ruled in favor of the policyholders in dismissing Cincinnati's motion to dismiss. So it remains to be seen how this will play out, and likely it's going to be extremely fact dependent on what's in the policy. I'll just tell you, IMA's advice to all of our clients, whether you have a virus exclusion or not, is to submit the claim to your property insurance carrier if you think you've suffered a loss from business interruption or business income. You just never know how case law will develop and if it will develop in your favor. We think it's advantageous to insureds to have their claim already logged in the system. Even if the carrier denies it quickly, it can always be reopened if things change. So that's typically been our advice. So with all of those, uncertainties and challenges and pressures on insurance carriers, really we're seeing rates going up across the board on every type of insurance and in every industry segment. This is the data, the prediction from the 2020 market outlook that USI published in July of this year. You can see, obviously, some of these are really, really wide ranges. Umbrella and excess liability risk management, which generally means large towers of insurance. Maybe they're buying 50 or 100 or 200 million in excess limits. They're predicting that those premiums will go up by 25% to 100%, which for those clients, for those customers, that's a huge increase. But you can see it, regardless of what kind of insurance that you're buying, you should plan on rates going up. Specific to A&E, there is a professional liability E&O line item in here of 15 to 50%. I will caveat that and say that it's probably not, it's definitely not in that range for the A&E professional liability product specifically. I think if they included an A&E line item in here, it would probably show something of like up 5%, maybe 10%. And again, most everyone on this call probably is familiar with your own loss picture and how that has impacted the premiums that you've paid over the years, and that will continue to be the case. And these are just some additional lines that were included. Environmental is maybe something here that a lot of folks on the line might purchase, or might purchase it in combination with your professional liability coverage. And environmental is seeing rate increases of up to 10% as well. And then this is the data from the Market Scout report, and this was really what they published just now, October, for the look back on the third quarter of 2020, where they said the average rate increase was 6.25%, and this is just their breakdown by line of coverage. And you can see professional liability in here. They're showing a 7.5% increase. That's probably more in line with what I've sort of seen across the A&E professional liability space. And some clients' increases have been 0 to 2 or 3% range, and some have been 5 to 15% range. So there's a wide margin, but on average, it's in that sort of 7.5, maybe 10%. So with that backdrop, the things that your A&E professional liability underwriters are looking at from an A&E market standpoint is really, it really all starts and stops with the Architectural Billings Index that's published by AIA. And I'm sure everyone on the phone, as you manage your firms, you're familiar with this index. Some of you are probably part of the data set that they track monthly. But you could see there was obviously a big dip in monthly billings and in firms reporting declines in month-over-month billings, obviously starting in March at the start of the pandemic. Recovery has taken place to some extent, but the ABI still being at 40 for the month of August, is just showing that the recovery isn't happening as quickly. And being in the eighth month of the pandemic, I think one of the previous speakers talked at the Elevate conference a couple of days ago, talked about the average backlog for A&E firms being somewhere in that 7.5 to almost 8 months of backlog. Well, we're in the 8th month of the pandemic. Firms are billing less month after month, although the recovery is showing signs of recovering. But with more inquiries into A&E firms leading to fewer actual active contracts or projects, it's sort of an area of concern for underwriters as they evaluate their insureds with respect to their annual billings and their ability to backfill that backlog to keep their people busy. AIA, along with the ABI monthly report, they have these comments from around the horn that really just reinforce the conclusions from the data. This 4-person firm in the Northeast saying a lot of interest for proposals. If only they would convert to actual projects, we would be busier than we were in February. There is some cautious optimism out there that the recovery will yield growth in monthly billings, and insurance underwriters, your A&E professional liability underwriters, would love to see that. So that's sort of in the big picture, the overall backdrop from the large insurance industry and what they're dealing with, the economic environment for A&E firms that your professional liability underwriters are looking at, and how they're sort of planning and managing their business into the next few years. So let's just spend a little bit of time talking about the things that your A&E PL underwriters are really focused on. As I said, underwriters are tracking the ABI closely. Really every carrier that we work with, 20, 30 different A&E insurance carriers, they all have someone in their group that tracks the ABI and reports to their fellow underwriters, just because, it is a leading indicator, obviously, for the construction spending in the overall economy, but it also is a leading indicator very specifically for the billings that will show up on your applications for renewals. And that billings is the single largest factor that A&E professional liability underwriters look at when determining your premium. So if billings are going down, they're going to see premiums going down, but they still have these external pressures on them for claims and other things that are forcing them to take even harder and harder looks at what they can do to achieve underwriting profitability and maintain a combined ratio closer to 100%, or in general, they would like it to be, maybe in the low to mid 90s. So the best way for insurance carriers to avoid claims in the future is to really take a look back at the claims that they've had, and learn from those claims and adjust maybe they adjust their premium rating models, maybe they adjust their policyholder their policy language, or adjust their appetite with respect to the types of firms that they'll write insurance for. One leading A&E insurer conducted a study of tens of thousands of their claims. I think this report was published in like 2012 or 2013 time period. So it was, it was quite old, I guess, data, but some of those claims just take so long to close out, fully mature and close out, that you're always looking backwards quite a bit. What they found is that 70% of their claims have non-technical factors that contribute to technical errors or maybe exacerbate a technical error. So they felt like it was important, and they are not the only carrier. I mean, every carrier in the space really concluded the same thing, that if we can focus our insureds on this non-technical side of the equation and things that they can do from a project or practice management standpoint, maybe it's better communication, better documentation in the file, working better with contractors or clients, contract administration through the life of the project, or even things like client selection and project go, no go type decisions, that they could really have a big impact on driving those claims downwards, even with the same number of technical errors, because we know that perfection is impossible to achieve, particularly, we talk about the standard of care all of the time in A&E professional liability and other professional liability spaces, and perfection is just not achievable, and it's not the standard that you're held to. So we know there's going to be technical errors of one form or another, but if we can really eliminate or reduce the non-technical side of the equation, we can go a long ways towards reducing claim volumes overall. Smart Risk also did a survey that they published in July of 2019. So this data is a little bit newer. They have found a rising, an increase in the number of claims from a technical side. They've seen technical rise to 57% in 2016, but they really make a specific distinction between whether a claim is technical or non-technical and not both. Whereas the insurance carrier data above didn't make that distinction. A claim could very well have both technical and non-technical factors. So they're seeing more, I guess we're seeing more technical errors across the industry, but it's certainly not believed that there's any less of an issue on the non-technical side. So underwriters remain intensely focused on those non-technical factors. So just talking about a few of them as we wrap up, I think we're approaching maybe 10 minutes left. One of those very obviously is the client, and underwriters are intensely focused on how A&E firms establish client relationships. There's always a question on every application about how much of your billings is derived from repeat customers. Underwriters love to see that number as high as it can possibly be. The situations, and hindsight's always 20/20, but when you have a project that goes really, really badly, you can almost always look back and see some potential issue with the client that maybe was a red flag that should have been at least talked about throughout the selection phase. I think the biggest one that I see in claim scenarios on a regular basis is just this area that underwriters talk about with respect to clients having a clear and easily articulated vision for the project. There's no better way to have an unhappy client at the end of a project than to have a client who doesn't know what they want at the start of the project. How can you meet their expectations or exceed their expectations if it's not well documented what those expectations are? There are a lot of factors that go into this sort of client selection conversation, and your insurance carriers are more than willing to talk to you. Just about every carrier in this space, by the way, has some sort of risk management offering that they will provide free to policyholders. So I'm sure there's someone at your carrier now who you could pick up the phone and talk to about any of these topics. And I would strongly encourage you to do that. The project type is also a big piece of the equation that underwriters look at. You know, as an A&E firm's project mix shifts from maybe low in one type to high in another type on their annual renewal application, it always has an impact on the pricing for your renewal premiums. Everybody is probably aware that residential has you know, delivered significant claims to the A&E professional liability market. And this isn't single family homes or custom homes. This is condos and townhomes and projects like that. You know, most carriers would say that the value of the claims from those types of projects far outweighs, you know, the premium collected for their clients that are doing those types of projects. So, you know, just on a proportionate basis, a lot more claims coming from these residential type projects. Underwriters love for their insureds to strongly consider, you know, project type. Is it the first time that you've stepped into this type of a project? What's the project delivery method? And do you have, if it is, you know, full scope design build, do you have design build experience with that design build contractor? There's geographic considerations, you know, certain jurisdictions are much more difficult to work in from a professional liability standpoint than others. There's political sensitivity involved with public projects. And, you know, if you get into a claim situation with a public owner and your jury is made up of public taxpayers, you could potentially, you know, face a bad result. They focus a lot on consultants and how you engage with those consultants, you know, particularly if you're the prime architect and you're hiring subs of any type. Obviously, they want to make sure that that consultant has been vetted with respect to the personnel available to work on your project. You just like client selection, they want you to have past experience with those consultants. And one of the things that they see a lot of times in claim scenarios is this last bullet point here, you know, client selected or client controlled consultants where, you know, you're the prime architect, but the client says, I want you to work with this MEP. You know, ultimately it becomes a business decision. Hopefully you have some past experience with that MEP firm, just as an example, but, you know, it can cause problems when that MEP may feel like they have a direct line of communication to the project owner, and you know, they go outside of their normal channels that they should be utilizing with the prime architect. Obviously, adequate insurance is a big deal for sub-consultants. You know, as the prime, you're going to be vicariously liable for any of their work as well. So if they've only got $1 million professional liability insurance policy, but there's a $5 million claim, you know, that next $4 million is going to come from somewhere, and it's probably going to come from you. So, you know, there's a lot of focus on drilling down to what's the type of project and the type of consultant that you're engaging for that project, and then tweaking the limits that you require from them. You know, what you need from a structural might be different than what you need from you know, interior designer, for example. So it's highly dependent on the facts, but they want to make sure that there's a process internally for evaluating and coming to reasonable decisions, and not really just making exceptions across the board. And speaking of exceptions, the final piece that we'll talk about is just contracts. And underwriters really view your contracts as the single most important risk management tool at your disposal. You know, a good contract can help protect from bad outcomes in a lot of cases. But really the basic things that a good contract will do is allocate risk to the party that's best positioned to manage that risk. And that's sort of an insurance 101 type concept, and it's put in practice in a lot of ways in the insurance industry itself with respect to, on a complex construction project, who is buying the insurance for the project. It should be purchased by the project member, whether it's the contractor or the owner or the A&E firm that has the ability to manage that risk. So an owner, it doesn't make much sense for an owner to buy an A&E professional liability project specific policy on behalf of the A&E firm or the design team, because they don't understand or know all that goes into managing that risk. And the A&E, the prime architect or the A&E team that understands that risk should be the one buying that project specific policy if it's necessary. Obviously, there are best practices with respect to negotiating tactics and contract language, but the things that your underwriters really are near and dear to their heart are good standard of care language, not providing warranties or guarantees, indemnity provisions that don't extend to a defense obligation, indemnity provisions that are limited to the extent caused by your professional negligence, meaning your proportionate share, and then insurance requirements that are reasonable. I would say, I highly recommend that you find a partner if you don't have one now, whether it's maybe external counsel, maybe it's an industry consultant, an insurance broker, your underwriters might have a resource internally, but find a partner that provides contract review services and really lean on that partner. The more often that you send them your contracts to review, the more they will become familiar with your business itself and your contracting philosophies, and it should become a more seamless process to get their input as they become more ingrained in your contract negotiation process. But you'll benefit a lot from that. And just one last plug about IMA, we do have a contract review service that we offer free of charge to our insureds. That will provide red lines if that's your fancy, or an email list of things that our attorneys, and these are attorneys that we will recommend that you at least strive for in your negotiations. That's a little bit different from our competitors who, for the most part, their contractual review resources are really limited to the insurance requirements. Basically evaluating those requirements and saying yes or no, your current insurance will meet those requirements. And we really do go a step beyond that, and we will look at the indemnity. We will look at the standard of care. We will scan the contract itself. Maybe there's another standard of care that's sort of embedded in the scope of services. So we'll look there too. We'll advise on all of it. I'll close up here with brief findings from the 2019 AEC Professional Liability Survey of Carriers, and this was about a year ago, so the new survey should be coming out. But as of this time a year ago, 11 of the 15 insurers who were surveyed ranked annual billings as the single most important characteristic of a firm in their premium determination process. The other 4, obviously it's still important, it just wasn't the single most important. These, like I said before with the Architectural Billings Index, they fully expect the annual billings to eventually see a dip, meaning their premium rating is going to see a dip as well. But they're still expecting claims to be presented, so they're going to have to charge higher rates, even though there's a dip in that exposure basis. At this point last year, half the carriers expected that there would be essentially no change in their rating, while the other half expected modest increases. And I can tell you from recent client renewals, I just got a quote yesterday, and there is a much wider sentiment across the market for trying to take rate where they can. If you're out to market early and often, you can probably withstand those in the current environment by introducing a little competition. But then you have to be prepared to move. And obviously with this type of insurance and the relationships that they involve with outside, defense counsel, panel counsel, whatever it might be, claims adjusters, all of that. Sometimes moving to a new insurance carrier is painful. So I think we're going to see some increases, certainly not nearly to the extent that the broader market is seeing, but I guess that the ultimate conclusion of this discussion is A&E professional liability is not fully insulated from the broader market moves, and you should expect to see some level of pressure on your renewals. So with that, Chad, do we have questions?
Yeah, we actually have a few queued up, but just let me say first, that was very good information. Insurance is like an iceberg, and this is, and I have a little experience there. It's good to know what's on top, but you've got to have that good partner, that radar, really looking underneath and seeing what's out there, because it's big and it's complex. But let's get into a couple of questions here. One coming from the audience is that, we are seeing more condominium projects and only take on those project-specific professional liability insurance that covers the entire design team, paid for by our client. Have you seen a rise in the availability or use in these types of policies? And maybe they're referring to the client covering the liability portion.
Yeah, I mean, I'm dealing with one right now, and I can tell you there is probably been the opposite of a rise in the availability of these types of policies. I have a client in the Denver area who is in this exact situation, and we're basically just out collecting denials from the insurance carriers right now, and a lot of it is because the carriers that do offer this, project-specific professional liability for condos or townhomes, they have significant minimum premiums associated with these policies. So I think with Star writes a lot of these. I want to say their minimum premium is around $100,000 per million of limit. So if you want a 1 million policy, the absolute least you're going to pay is $100,000. If you want a 5 million policy, you're going to pay $500,000. AWAC offers single project professional policies for condos and townhomes as well. I think their minimum premium is closer to a third of the limit. So that $1 million policy is going to cost you around $330,000 in premium. So the real challenge here is obviously when you've got large projects with a lot of design fees associated with those projects, you can find somewhere in the budget to buy this project specific insurance. But the one I'm dealing with right now, the total design fees are, less than $200,000. And they are, they need a $2 million limit that's been agreed to in the contract. So a $2 million limit is the premium is going to be more than the design fees themselves. So it's almost a showstopper right there. So it creates a real challenge for that segment right there. There might be some increase in the availability if you will strip away the sort of project wrap feature and only buy the coverage for the prime design firm and not for the entire design team. But then obviously you're losing a lot of the benefit of the project specific professional liability policy in general in the way that it works. So I feel like it's still just as difficult to place those types of policies as it has been in the last couple of years.
Okay. Well, good question. Thank you for that one. Another one that came in, and we're still holding strong with the audience, so I figured it's okay to go over a few.
Okay.
In some industries, we've seen administrative costs, including our own, been reduced greatly during the pandemic period. Do you think insurance industry are you guys seeing those same types of administrative costs, or have yours gone up? And do you think that affects premiums or the cost of insurance overall?
Probably. I mean, I think some of the larger insurance carriers were already making moves towards allowing their folks to be remote, as early as 3, 4, 5 years ago. They sold a lot of their big real estate. I think AIG sold their building in Lower Manhattan in New York some time ago. And so they've tried to become a lot more flexible with respect to those, really big overhead line items like real estate. And I think it was Zurich who made a decision maybe 5 years ago to send all of their underwriters home. So none of them had physical assigned workspaces in the office anymore, so they could significantly reduce their real estate footprint and the square footage required, as maybe only 20% of underwriters would come to the office on any given day, and they would just, reserve an office for that one day and then be home the rest of the week. So I think that the way that the direction the industry was going was already sort of being pushed in that direction, that the pandemic sort of accelerated for a lot of people. Obviously big investments in IT are a part of that. Hopefully they bear fruit in the long term, but in the short term they can be costly. So I think in general there might be some pickup on that expense side of the equation. Obviously people are traveling less, so their travel budgets and entertainment budgets with taking clients out to dinner or whatever it might be. I think that there's definitely an area that can be reevaluated, and hopefully people will be successful in making that argument to insurance carriers that, the dynamics of that combined ratio have changed a little bit, and maybe they can withstand some greater levels of underwriting losses because their expenses are going down. But the one side of that though is, people still earn what they earn, and that's not changing. And so that's probably the biggest piece of the equation, I think.
Okay. So we'll do one last one. It's coming in. It's how much time do you need to collect insurance options for a client or prospect in the professional liability space to avoid situations where your insurance spend could exceed the contract?
If you're talking about project specific insurance, like for that specific contract, your existing insurance broker that probably knows you well, probably has relationships with specific underwriters out in the marketplace that can turn a quote around for you pretty quickly. The challenge though is that there's just not a ton of room for negotiation when it comes to project specific professional liability, because the underwriters view it as a pretty large potential source of claims. They might be willing to come off of their initial pricing by 10 or 15%, but to find something that's dramatically cheaper than what they come up with is oftentimes difficult. So you really do need that time to sort of scour the entire market and make sure that you don't leave any stones unturned. That can usually be done in a couple of weeks, but to be safe, I would generally say, closer to 3 weeks is probably better. If you're looking to engage a new broker who hasn't, had a relationship with your firm in the past, there's obviously going to be a learning curve to that as well, as they, sort of learn what you do and try to align your expectations and needs with what's out there in the marketplace. On an individual, if we take our project specific hat off and we just talk about your annual practice programs, generally very quickly you can obtain, alternative pricing from other carriers to provide some competition into the renewal process, a matter of a week or two, a lot of times. But the earlier you start, the earlier, the better you can pivot. I usually like to try to get the renewal quote from the incumbent carrier, at least 30 days prior to the renewal date. That way, if it is, a bit of a surprise or unexpected or something that we don't like the result of, and we can't get them to budge, we do have a few weeks to go out to the market and at least, kick the tires with a few different alternatives to make sure that we're not really getting taken advantage of and being charged some unfair premium on the renewal. So it's not months, but it's definitely weeks.
Well, that was the last question in the bucket for this discussion. I think, Dan, if
Okay.
you go to that next slide, we'll have your contact information. So if anybody else has any additional questions, definitely reach out to Dan or Cole there on the slide. Like you said, they do things like contract review for free. Just the nature of insurance is to try to help and be there on your worst day when you might not expect you need it. So being prepared for that is extremely important. And it sounds like these guys can take care of a firm from everything from the smallest policy up to the largest umbrellas.
Absolutely. Thanks, Chad.
Cool.
I hope to hear from anyone who has additional questions, and hopefully we'll see everybody in person next year.
Yeah, definitely. Looking forward to making things happen, potentially there in Denver. What we'll do is the recording of this will be available here within the next 24 to 48 hours, I believe. So if you did have any questions, don't hesitate to reach out to these guys, but otherwise you'll also get a refresher of the material in your email.